Trading the foreign exchange market carries high risk and may not be suitable for all investors. Trading on margin, utilizing leverage can carry an even higher level of risk that can lead to a complete loss of investment funds. So before deciding to trade the foreign exchange market or using any of our software alert products, you should carefully and diligently consider your personal investment objectives, level of experience, and risk tolerance. There is a possibility that you could potentially sustain significant loss. You should not invest any capital or trade that you cannot afford to lose. It is your responsibility to be aware of and understand all risks associated with foreign exchange trading and to seek professional advice from an independent certified financial advisor if you have any doubts. Avoria Prime does not exercise trading authority over your trades. You and you alone exercise discretionary trading authority over every trade.
This is basically an outlook starting from a weekly chart, a big picture view. We have price. Basically this is 16900. So we have this whole level, and this is a weekly view. So again, we could just see coming down into this area where we've had actually a decent amount of buying pressure before in the past. We haven't actually been down there since December, and then obviously this week we had price action. We had a rejection at that level earlier in the month, and then we go down to the daily time frame. You can basically see that we're heading into this level right here, where we've basically just been in this, this little range right here, kind of moving between 171 500 and again 171 one-ish flat, somewhere in that range. So I mean, we could see where price is at, and personally, from just a technical outlook, we can see this range right here. Just kind of see price bouncing throughout this little channel here. So that's where we're at from a technical perspective. I mean, looking to see if price does break. If it does eventually break from this and we break out of this, we can kind of see the room until the next level that we actually have had some rejection at, which would be here in this level. And again, it wouldn't necessarily move up here that quick, but this is kind of like the next level that I see a decent amount of reaction at. And this is where we're at from a technical perspective. We've just kind of been bouncing throughout this range.
Thanks, that's a really good analysis. I agree with what you're showing on the charts.
Yeah.
Just so people know, this is the daily chart, and
this is the daily chart.
Yeah. So just to point out, in that range, like if let's say a trade was placed at the edge of that range, that band or trend line, trend channel, we would get a stop loss if it was in the wrong direction. So that's a pretty big swing, maybe 150 pips or so.
Yeah. So from here to here, it's 104. Yeah, about 150 pips. It's actually like the range we're trading in.
So 150 pips. So that needs to be, I think, at least considered. When we're in the trading window, though, usually things are kind of calm and
so we can
not getting a lot of movement, but it needs to be. There was some news that some people didn't want to trade yesterday because there was some news early in the morning from I believe it was the Bank of Canada, and a lot of data points for the Canadian economy were released this morning. So they felt like there could be some volatility, and if they had trades open, perhaps they'd get exposed. So I don't think anyone got a stop loss last night.
I got out from the trades quite quickly. I don't think I do have any trades open.
I don't think anyone got like a stop loss. I think most people got a take profit yesterday. Maybe someone can say in the chat their trading experience yesterday, how it was. On the brokers, I observed there was no issue and got out of the trades and made a profit.
Yeah. So like Robert was saying, that was from a daily and weekly, and I like to just get an idea of, basically looking at those time frames, because then you can kind of like zoom down to these time frames and you could actually see those trend lines, like how that actually equates to like lower time frames, 4 hour and 1 hour, and we can actually see, the rejection at those levels. We're inside this channel, and it just gives you a good idea, because at least the way that I think about it is like, when you can look at the chart from this higher time frame and you could see buying pressure, selling pressure at different price points, it's, to me at least, what it communicates are those are price points that institutions or larger hedge funds maybe had interest at before. They had interest at those price points because retail traders can't necessarily move the market like this at this price point. So that's why I'd call these like demand areas where there's actually like buying pressure from an institutional level. So looking at those levels, and then we can go ahead and zoom down. We can basically see how that actually equates on a smaller time frame, a 4-hour structure, kind of trading inside that channel. But like Robert said, so with most of those trades, we're gonna be in and out, but longer term perspective, that's at least my outlook and like the price points that we're running into.
I think that's a really solid analysis.
Yeah, man.
Yeah.
Very, very good.
And it does make a difference. Like, let's say there's some news and we're right on the support or resistance, and we have a trading session. It is possible, for us to take that into consideration, meaning that there could be more volatility than usual if we're at a popular pivot point.
True, yeah.
We did have a really good questions from Heno. I'm not saying the name right, but
Okay.
So he was saying on last call, we stated that we would not use 50% with any serious amount of money. A significant amount of money for us, we wouldn't trade 50% risk. And he said, why is that? If you're going to make more money in the long run, running higher risk, why wouldn't you do that? And it's a good question. And really, the fact that I think it was you and I both said that we wouldn't want to put like our life savings at 50% risk, mostly because if we actually had a 50% loss, we'd cry ourselves to sleep for a while. And in my case, since I'm married, I might actually be homeless. So, you know what I mean? Like, it's something to where it totally is subjective and up to your own risk tolerance. So if you can stomach a 50% loss, by all means, run it. And theoretically, you'll make more money than someone that's running 25% risk in the long time.
You guys, it's not even Robert McDonald's rule. It's actually Miss McDonald's rule that he's not allowed to crank it up.
The emperor. Fernando's met the emperor in person several times.
Yeah. You gotta be on the happy side. I've known some people that aren't on the happy side, and she was tempted to use a window out of a rooftop to just.
She didn't use any force lightning against you, did she?
No, I was straight up in the good side.
Or suspend you in air and try to throw you or something.
Yeah, we actually have to get it signed off on her end before we do anything on the business side.
Robert, are you aware that this is being recorded and it's gonna be in YouTube, so you might get in trouble?
Yeah, I'm already feeling a presence tightening around my neck right now. I better shut up.
Let me add to that. She always has, the best advice. I always agree with that 100%. So
that was funny, man. So actually, there was some stuff I wanted to cover really quickly from maybe mix between technical and fundamental standpoint. And it's the fact that today we do have NFP day, which is pretty much employment data for USD and for CAD. And we do have a very interesting situation because last time we had the NFP, I think the data was, the expectation for the NFP was really, really high. And then, it just staked a little bit, and it wasn't much change. And it seems that these we did have some improvements from last month's reading, from 270 something K jobs generated all the way up to 560 or so, but the expectation still was in the 600 range. So we're still not meeting expectations. It seems that the hiring rate through the PMI stuff is not catching up to speed, and the hourly wages are not increasing, as expected, for all the economic recovery. So since we already had the NFP happened on today's session, it seems that it did affect it quite negatively into the USD pair. So it seems that the USD in general took a hit. However, on the CAD side, if yeah, we just take a look at how the market reacted, for the readings from the CAD, it seems that even though it still had a relatively bad outlook on the job count, it didn't generate much volatility. Actually, if we take a look at the chart that Nick was showing, we didn't have that crazy of a move. Or also, if we check the Canadian index, dollar index, it doesn't. I mean, it didn't show that much of a move when compared to the Dixie, which is the USD dollar index. So yeah, that's something to consider. That even though the USD side of things did got rather affected, the CAD side of thing, which is the one that affects us the most because of the pair that we trade with, didn't got that much hit. So yeah, that's something very interesting to just keep in mind on today's session about the overall market situation on that perspective.
You want to know something that's interesting?
I want to know
Is
something that's
that
interesting. Yes.
I look more at the U.S. stock market. So that's the dollar does its thing, but I look
Yeah.
mostly at the S&P 500, and I'm noticing that this morning the S&P 500 is up. So if there's negative data and the S&P 500 is up, what does that tell you?
But we're into a
Nick,
very,
what do
very
you think?
interesting
Fernando, what do you think?
situation.
Why does the stock market go up if negative data about things specific to employment and things of that nature are negative? Why would it go up?
Well, because Wall Street doesn't care about the people, I think.
You're exactly right. This is all that Wall Street cares about is that the Federal Reserve will keep accommodating them in order to have lots and lots of easy money to borrow and let cash flow. They want lots of liquidity in the markets and lending to be flowing, right? So people can over leverage themselves and buy stocks. So if the data is negative, that means that the Federal Reserve will have more tools or reason to keep continuing the policies that they've had, which is accommodating, right? So if the data was really positive, then it's possible the Federal Reserve will say, hey, we're going to back off from all this stimulus stuff and blah, blah, blah. And we're going to kind of rein things in a little bit. The stock market would crash. Not crash, but would start going down. So that's why there's an inverse relationship because of the manipulation of the Federal Reserve. And
yeah, very, very nice thoughts, man.
so it's
Actually,
weird.
it's very interesting because if you compare, for example, what the dollar index is doing, actually, I think I do have 1 second. Let me show you. So this is the S&P. Actually, let me get rid of this. There we go. So this is how the S&P has been behaving since March, which is right around the area where we had the crash, and then the S&P has been, just doing S&P stuff, going up, even though the overall situation is not that ideal. And actually, we do seem to have some slowing down around here, but around the daily once again. So yeah, this is pretty macro. So, but we do have this orange line is the dollar index. So it does seem that even though the stock market is increasing, the dollar index has been decreasing, which, generally speaking, tells me that the fuel that might be pumping the US market could actually be just the US dollar losing purchase power. So you do need more money to buy the same stocks. Because if
True.
we go,
That's definitely people are looking to put their dollars to work because if the dollar's losing value, they're going to want to put it through inflation. They're going to want to put it into something that's more of a hard asset. So stocks are one easy way to throw your money in and, oh, I have a stock, so it's going to help offset the inflation.
yeah, exactly. And actually, it's very interesting because it seems that during the pandemic, kind of like the heavy months, which is right around this area, when the S&P dropped, the US index increased. So it seems that a lot of people dumped a lot of money into, or actually took a lot of money out from the markets just generating demand for the USD and stuff. So, and
Mhm.
generally speaking, if we go a little closer, this is what I was referring to a few minutes before. This is kind of like the drop we had because of NFP today on the US dollar. But interesting enough, the read from the US employment data was actually positive. It just wasn't as positive as expected. Then on the
It's
CAD
all
side
about
of things,
expectations.
exactly.
It's all
It
about
wasn't
expectations.
as good. Exactly. It wasn't as good as expected, which is negative altogether for the markets. And then with CAD, it was actually worse than expected, which was actually, it was expected to be bad, but it turned out to be worse. And if I move to the Canadian index, which is one second, I think should be, there we go. If we move to the Canadian index, which obviously doesn't have much movement when compared to the USD, we did had a positive movement with
Yeah.
today's NFP, which is, very, very interesting. And it seems that the market doesn't care really much about Canadian markets and all this stuff. It's mainly USD driven, but still having this into account is I think, very, very interesting to see. For example, when we take a look at the GCAD pair, which, as you can
Mhm.
see here, the 4-hour for today, the 4-hour bar for right now, so to speak, hasn't moved that much. And yeah, that can be, I just find this very interesting, that seeing that there's a very, very interesting dystopy, if that makes sense, between how the market reacted to the USD side of things and to the CAD side of things. So
It's all about capital flow. So
yeah,
capital flow, when there's a risk-on environment, capital will flow from cash to stocks or real estate or what have you. And the capital flow will go from stocks or more speculative investment vehicles into cash when there is fear in the streets. So right now that the unemployment wasn't as good, it's basically green lighting the Federal Reserve to maintain its policies and also the federal government to maintain their stimulus checks. So the market's happy about this. They want this to continue.
yeah,
Yeah.
it's a very, very interesting situation altogether. But as you said, man, it's I'm even tempted to say that negative employment data might even boost Wall Street a little bit, just because less expense, in wages and payrolls and stuff, and probably less people doing the same tasks. So just
It's all about what the only thing that really matters to them is what the action of I'd say stimulus is really good because people grab those checks and then they spend them on goods and services. But the other thing is that how accommodating is the monetary policy going to be? That's a huge, huge deal for
yeah,
investments in equities. Huge. So as long as they know that the policy is going to be accommodating, they're happy. So they don't want people to go back to work. That's not in their best interest. If like the government says, hey, we're going to start moving back the way things how they should be and reel things in a little bit and raise interest rates and blah blah blah, the stock market will crash. Yeah.
yeah, exactly. Actually, if we take a look at the current, actually, let me. What was the name of the movie where hedge fund manager locked in the money from everyone and then did a big short that ended up kind of like predicting the 0809 crash?
You
It
just
was the Big
named
Short.
the movie. It's called The
The
Big
Big Short,
Short.
right? Yeah.
Yeah.
Okay. In Spanish is very, very different, man. The name in Spanish, I think it's La Gran Apuesta, which is the big gamble. So, yeah, it's a little different. So I wasn't sure if I was getting the name right. What was
No,
the
you
name
got it
of the
right.
what was the name of the manager?
Barry. His
But it was
first name.
very, very something.
I forget. His first name's Barry,
Me
but
too.
um,
Let
he
me.
he actually does a lot of tweets and stuff, and he'll tweet about his opinion, then he'll delete it right afterwards. And he just
Yeah.
does this to have like a record of what he's saying, so when it happens, he can go back and say, I called it this time." Now
Yeah.
he's saying that the markets are. He basically thinks it's a zombie economy. So a lot of the businesses and households in the world are just maintained by the
Michael
easing.
Burry. Sorry,
Yeah,
just
Michael
found out.
Burry.
Yeah.
I call him Barry.
Yeah.
Oops. Burry Berry.
I think it's close enough.
I messed that one
So,
up. I messed that one up. Okay. But anyways, yeah. So Michael Burry doesn't believe in the U.S. economy right now. He thinks that it's artificially inflated, and that as soon as things start to swing back to normality with interest rates and monetary policy, that the stock market will suffer. And I share his opinion. And you can
yeah.
see by today's news that the overall market feels the same way. So bad news is good news for the equities market.
Yeah. No, and actually, it's very interesting because if you take a look at what triggered the crash last time, which was pretty much subprime lending, but applied to housing market, that was pretty much kind of like the match that ended up blowing up everything. So, if you take a look at what's happening right now, it's pretty much the same situation, but applied to a different sector. Because there's a bunch of close to free interest loans. There's a bunch of, okay, we don't care about how your business is doing. We don't care about how your business was structured. Here's some money, bring that up. And I mean, the overall situation of the world has changed so much that if you get into a loan of probably a decently sized loan just to bring up back your business to where it was before the crash, and then you're just going to thinking that the overall world situation is the same when it changed a lot, and a lot of people, I mean, a lot of businesses need to go digital, a lot of businesses need to go or need to restructure how things were, and people are just thinking, oh, I'm going to take a loan because it's cheap to pay it on a monthly basis to recover my business, help out to get things back where they were, not thinking about maybe if they go back where they were, you're not going to stand up again, And it's only a matter of actually, if you take a look at what's happening about governments giving literally no interest loans, giving people like a 1 year worth of periodo de gracia, which is kind of like a period of time where you don't have to pay it. So you have kind of like a little buffer of time. I mean,
grace period is the word you're looking for.
Grace period. Yeah. It's very similar to the subprime stuff that happened in 08, 09, which was just a period of time where the interest rates were favorable. But since the loans have variable interest rates, then it wasn't, evident straight away when all this was gonna just go.
When they balloon, yeah.
Yeah. And actually, just by looking at the amount of debt that's in major economies such as the US, and even just by, educational debt, like college, university, and all this stuff, it's very, very concerning seeing all these people getting into massive debts, a lot of people that are very, very soon to graduate and getting into employment market, which is deflating and getting smaller and smaller, where the wages are getting are not increasing in pace with inflation, and the periodo de gracia stuff getting closer and closer to the end. It seems like a perfect storm is coming, but I'm just delusional. I'm just a person that's
you're not at all.
Coffee. And you shouldn't hear any financial advice from us right now. Just
these are just
get in trouble. All opinions from people that like cats. Well, I'm sure if I think Nick is more on the dog side of things, but he likes. I think he likes cats too. So
we're all animal lovers. So
yeah,
it's definitely there's a bit of an everything bubble going on right now. And it has to do with a lot of the things that you mentioned. So it's not just real estate. It's not just like the housing market in the United States is obviously heating up. It's not just equities. I mean, a lot of things have been disconnected because the market is now, I'd say, artificially inflated.
It's pretty much just a different creature. It's even more disconnected than Main Street than it was before.
It's kind of similar to someone like being in a bed and they have back pain and they're being fed a morphine drip. And what's their incentive? If they want to keep the morphine dripping, they don't want the doctor to come in and say that they're getting better. They want the doctor to come in and say, no, actually things are kind of bad. So we're going to have to increase the amount of morphine you're going to get. Ooh, and that makes them happy. So that's a little bit the dynamic that's happening right now with the markets, is that the morphine drip is all this liquidity that's being thrown into the markets and this kind of free money being thrown around. And so bad news is good news. And if the economy actually does start to pick up, that means that the morphine drip is going to be reduced or turned off. And then the economy, then we have to see what businesses are real or what are zombie businesses, which are just held up right now by credit. What households actually have savings and what households are literally just surviving based on credit. So the amount of debt that's being generated by the last year and a half of policy is, not going to be pretty when it deflates. And segueing in, why are we currency traders? Well, what's the safest place to be when people are desperately trying to liquidate their assets? They're liquidating into cash. We trade in cash. So we're always in a strong position if the market were to reverse, because we have that cash on hand, because we don't have to convert anything. Our accounts are in euros or USDs, and cash is king whenever there is these reckonings that happen. So I think that we, as currency traders, I think that we're really well positioned. If we had our money in real estate or even in stocks, we'd most likely take a pretty big hit before we'd be able to cash in, to go into cash. But with us, not a concern.
Yeah, it's a different creature altogether. And actually, if you do like how the currencies have interacted with each other during a pandemic and all this stuff, it does make way more sense than what's looking like into the equities market. So Nick, you were showing something, buddy.
So basically that was an article by Experian. It basically just said that we're at record highs for consumer debt, business debt. Like we're breaking records.
Yeah, we're literally, it's so interesting. We're on a credit fueled high as a world. Everyone's high on credit. And so what's a symptom of that? Equities at almost all-time highs. Cryptocurrencies, not that they're in a bubble, but they kind of are, especially the meme coins. They're definitely in a bubble. So you have all these highly, highly speculative investment vehicles that really have no underlying value, and they're getting pumped up based on hype and people getting checks and saying, yeah, I'll throw it into Dogecoin or Shiba coin or whatever. And they say, or whatever. They throw it into something to try to flip it for, 2 or 3 or 4 or 5x, whatever, to try to make a quick buck. And that's the name of the game right now. What I will say is this is a temporary state. This will not last. Things will change. And one day people will look back at today and say, wow, how do we not see that coming? Well, the truth is people do see this coming. They're just not in front of you on the TV speaking.
Yeah.
But I can guarantee you a lot of the wealth funds out there, they have very, very smart individuals that understand what's happening, and they are very, very aware of the temporary nature of this credit driven market, or debt driven market, I should say.
Yeah, it's altogether, I think it's a very, very interesting topic, So yeah, actually I think we do have a few questions in the Q&A stuff. So
can I handle Jackie's? Jackie's saying, how do we manage trading under contracted economies? Like basically, or Jacqueline, excuse me.
Yeah.
Jacqueline Borea.
Yeah, it seems that we do have some support. Yeah, it's my mom.
Really?
Yeah, she joined.
You answered the question. It's your mom.
Well, you take pretty much a very, very, very big cup of coffee and just stare at the screen all day. Okay, jokes aside, when managing trading under contracting economies, it's here's the thing. It depends on what type of trading you're managing, because if it's equities, usually what you do is just drive. Generally speaking, what people do is take away the funds from equities and drop them. Well, actually, bonds are equities, but take them away from stocks and indexes, and then they usually drop them in bonds, which it's pretty much something to where if stocks are going good, then bonds are doing bad, and the other way around. And the thing is that right now, as we're in a contracting economy that's not being bad on equities, that means that, so to speak, we're into a very particular situation. If you were, for example, managing, into the equity side of things, it would to some degree make sense to have more exposure to the equities because of what's happening right now. But definitely it's not something to where you're gonna have just regular exposure to where you just allocate, more and more funds to an equities based fund or to an equities based portfolio. It's something to where you most likely would or should have or should consider the idea of that you're just dollar cost averaging to maybe slow down that a little bit more just because of the overall reason or fundamentals behind why the market is going up not being so solid. So pretty much it's something to where the market can just go south without any notice, and if you just assume that everything is normal, then that's going to leave you into a very very odd situation. Or actually you can think a little bit ahead of time and maybe do some allocations to the bonds and stuff. And or in our case, just segueing a little bit more into the FX side of things, it's a little different for us. It's pretty much normal, yeah, just normal management. We have our accounts, we just have the systems plugged in, and since the FX market has a little more connection to what's happening in the world, we are able to just foresee, oh, for example, the UK is having some chatting about Scotland getting out from the UK. So we just take that into account in any given trading session and say, oh, the markets are going way too volatile because of this today. And because the currencies are, it seems to be better connected to what's happening all over the globe, we're able to just manage accordingly to that. So in summary, just as a short answer to the question, it does depend a lot about what type of trading you're managing. If you're doing equities, once again, you most likely gonna want to have some exposure to equities altogether, just because even though they are artificially inflated, in our opinion, they are still inflated. And it's a market that's rising. You just gotta plan accordingly to the overall view that the boost in the rise in prices is being fueled by debt. It's being fueled by not by actually strong and sounded fundamentals. It's just fueled by people being happy that the government is dropping money on them. So you gotta have that into account if you're just gonna keep dropping money into them. If it's gonna be currencies, it's just a matter of understanding what the strategies you have are, what are the conditions in which the strategies perform best, and just if you do spot a particular day where you see this strategy might not be suitable for today, then you just readjust it accordingly. It's something like having a sports car and having a dirt road. If you're going to have a sport car and a dirt road, you're most likely not going to floor the car and go 60 miles an hour into that dirt road, because you're going to most likely break the car. But if you have an off-roader and an off-road road, then you can just crank the gas. And that translates to, if you have a strategy that performs well, but not under the current market conditions, then you should just decrease the risk or the exposure on that strategy. If you have a strategy that performs absolutely amazingly into those types of market conditions, then all for it. You just balance it out depending on how the market is looking. Hope that makes sense, by the way. And then we do have another question about NEO. So it says, does NEO take commissions into account when taking profit? Yeah, it reads pretty much the entire trade status. And I actually think that this question comes from the few instances where, we do have actually some basket closure of NEO that ended up slightly negative. And it is not, it's not mainly because of commissions, it's mainly because of slippage, because we trade during a period of time where there's very shallow liquidity. So if you want to close a trade for profit, and then it just happens that the order book, the price that you're seeing is it doesn't have that much volume back from it when you try to close the order, then the price actually just happened to move a little bit because of the low liquidity. So when you actually say, hey, I want to close here, then the market does this, and you end up closing down here. So obviously, this distance is not a commission per se; it's just the consequence of the low liquidity. So even though NEO does read a commission, swaps, and spread, and all this stuff, it still can happen that you do have some slight deviations from the closing, from where we should close an order and where it actually closes. So hope that makes sense. So
it does make sense. Thank you, sir.
You're welcome. We do have a few other questions. I'm going to leave those over to you, sir, and Mr. Nick too.
Nick?
Sure. So we have a question from.
Oh, I'm gonna do Thomas's really quick. He
All
said,
right,
if you adjust the risk, does it affect the number of trades you get? No, it does not. It is the same. It's only the size of the trade that changes. That's a question that keeps reoccurring, by the way.
Yeah.
Say, hey, if I increase the risk, and it's a great question. If I increase the risk, does the trading frequency change at all? Nope. Exactly the same. It's just a matter of lot size. Lot size changes.
That is very correct.
And then up next we have from Joshin King. What's the best amount you need in your account to access Neo? When we ran the test, I think I'm not sure exactly what the percentage was. Maybe you can help me out, Fernando. But it was with like we ran tests with $500, $600.
Yeah.
I think on the official videos, it's definitely more conservative. I think it recommends like 1 to 2K, something like that, in the actual videos and the training. So definitely a few $100 though.
Yeah, I think the bare minimum is south 300, maybe close to 400. But yeah, I mean, obviously you're not going to make up the monthly cost if you have a small account. But yeah, technically speaking, if you throw it in and run it, you can run, I think, from 300 to 400. So yeah, I would say that, just to summarize it, yeah, I think it's in the ballpark of 500. So yeah, and actually, just a big heads up. This is a very common question too, and if there are new people into this call, I think it's something that would be good to address, and it's the fact that you need more money to run a smaller risk, and it's because of the lot size. So, just to give an example about why this happens, you can just think that you're into a casino, and let's say that you have 100 chips, and then there's a person next to you that has 1,000. If that person that has 1,000 chips bets 100 chips, you can match that by betting 10 chips, because you do have 100, and then 10% of that is 10. And then it just happened that the other person's equivalent would be 100 chips. What happens if that person drops his bet size to 10 chips and he has 1,000? Then you have to adjust your size to 1 chip instead of 10. So you still can match that. But if the 1,000 chips person just places 1 chip in the table, there's no way that you can match that bet size, because you only have 100, and you can't break 1 single chip into 10 separate pieces. So that applied to Neo. It just happens that 0.01 is the smallest you can go with the lot size. So to cover the risk, the lower risk, you do need just a bigger amount of money. Then, so just translating back to the analogy that I was making, you just need more chips to stay in the game. So yeah, hope that makes sense also if anyone has that question, in mind. So, and also we do have a question from anonymous attendee, and it says that, what date did the official account started running 40% risk remote? I know last call you said that at the beginning the official accounts were running really high risk. That isn't possible right now in the current Neo settings. So yeah, I'm guessing that the person only wants to know when the switch to 40% happened.
We had 20%. We had 200% risk.
Yeah, give or take.
We would more than
a little higher.
We would more than just blow the account. We would actually have a debt.
And we would be just supporting the general economy right now. So
exactly. No.
Jokes aside,
you want me to show the official accounts really quick?
Yeah, sure. Yeah, it wouldn't be something to where we would get a 200% loss, if just so people are new people understand that fairly nicely. And it just happens that if an account were to have, or were to be halfway through a blow account, we would be already blown. That's what 200% risk means. So yeah, very high risk altogether.
Oops, just a second. Make sure I had the right account. I did.
Okay.
Just want to make sure I'm not sharing a different Myfxbook. Okay. So we're looking at our official account, updated 16 minutes ago. We have 68 people tracking. And that's kind of sad because we have over 1,000 people using Neo. Why
it's a plot
is so
to ask people to follow, huh?
Yeah, you all should be following this account because it's a very good way to measure your performance and our performance. So yeah, good old 251% growth, not bad. Expectancy of 4 pips, profit factor of 2.23, Sharp ratio of 0.27. Honestly, these statistics are pretty dang good.
Yeah, man. Pretty good.
With 17.84% drawdown. Really not that bad. In fact, one of the better accounts I've ever seen. So this year, this has been our track record. As you can see, had a bit of a dip in April. May was kind of a mixed month. And June so far is not bad. It would be nice if we can have another 15% month. So we were a little bit chicken in May though, as far as when we weren't running the system. So we were kind of hesitant, especially on mode 2. So hopefully the market remains rather calm. And if that's the case, then we can just let Neo do its thing and have another 15% month. Why not?
I like that idea, sir. And yeah, actually the question was about...
Don't lie, Fernando. You always write me and say, the market looks choppy. Let's pull Neo today. And I say, no, Fernando, we're running Neo today.
You're defaulting to take the risk, sir. I'm defaulting to, be a chicken side of things. And...
That's good that we have 2 different personalities.
Yeah.
And then we have the tiebreaker, Nick. Nick has to go and be the voice of reason and say if Robert's being too risky or Fernando's being too cautious, and then actually made a good call.
Yeah. And actually, sir, the question was when we moved into 40% risk. And you missed that part when showing the track record.
Say what?
Yeah, the question was when we moved to 40%.
Oh gosh, I got so excited. You made it to where I can't share anymore, Fernando. How rude.
I'm gonna be kind to you and allow you to share screens again. Actually, you are able to show screens, yeah.
I know. Okay. So when did this happen? It looks like we got out of hyperspace in August. So,
to the moon.
Exactly. We went full Dogecoin in August. And as you can see the trajectory. So it looks like around here, after we had the first kind of like big loss, I think that's when we were like, maybe the risk thing that we're doing is a little bit too high. So probably around mid-September or so, it looks like September 16th, we kind of wised up and started using more reasonable risk, because you can see the slope in August to maybe mid-September was quite extreme. And after that, you can see the gradient is very similar to what gradient we have right now. Yeah.
Actually, I think right around we had that dip maybe around April, we moved from 50 to 40. Because if you take a look kind of like the rate of growth before that section and then after, it's a little bit tamed or, reasonable actually. I mean, it's a 500% growth account.
So
but yeah, I would say that maybe around April.
From 50 to 40.
I think so. Yeah. I think I remember you telling me something like that. So
yeah.
That would be my guess around April.
Yeah, I guess it went from like 200% risk to 50% risk and then 40% risk.
Yeah.
Something like that. I think we're going to probably just hold it at 40% risk for a while.
Yeah, maybe
I think that's
I think it's in a level between 30 and 40. I mean, the thing is that if you have a beautiful account, why would you just allow it to go into a huge drawdown? I mean,
yeah, I mean, the reason why I like the idea of 40 or even 35% risk for this account is just because I like having the drawdown under 20%. And it would be nice if we can keep the drawdown under 20% for that account, because it's kind of like our official track record. We want to be able to tell people like, yeah, the system can be run more aggressively, but at the same time, it's also sustainable. And if we kept this risk, the account would still be going, but the drawdown would probably be closer to, I don't know, maybe it'd be registering 30 or 40% drawdown or something like that. But the growth would also be probably over 1,000%.
Exactly.
But I prefer to have a little bit lower drawdown and go kind of a slow and steady route. Also, I feel like if people are observing this account and we tell people, hey, we're using 40% on this account or 35%, they're maybe more inclined to use that risk versus 50%. And yeah.
Yeah, exactly. So, okay, there's a question asking about how someone can follow the account. So let me show that really quickly. Correct me if I'm wrong, Rob. Is this button right here the one that says "Add to Watch"?
Oh yeah, add
Okay.
to watch.
So you go
Add
into the
to
account
watch.
and click here, pretty much, and then you're going to be able to track the account. So yeah,
Then you
it's
can.
pretty
Then you're
straightforward.
you're considered like watching the account, and if you have a Myfxbook account, you can have like all the accounts that you are tracking.
Yeah, and actually they send you kind of like a weekly report too to the email. So
Mhm.
yep. And also there, Greg is mentioning, so around, oh no, the anonymous attendee is mentioning, so around September 16th. No, I was referring around, well, yeah, around September, I think we moved from massive to 50. And around mid-April, we moved from 50 to 40. And yeah, the person is just mentioning that we should share that into the academy. And actually, I think that's a good idea. Maybe we can do kind of like an updated overview on the track record or something like that. Yeah, I think that can happen.
Yeah, totally.
So yeah. And when it comes to notifying people when we make a decision on the risk side of things on the Telegram channel, we don't really want to do that because we're not advising which risks you should run. So that comes down really to personal preference. And the thing is that you can have 50% risk and consider that normal risk, and then you can have someone that has south of 30% risk and consider that high, So yeah,
Yeah,
it's
it's
relative to
very,
the risk
very
perception.
subjective.
Yeah, completely. And actually, I'm gonna plug right now Mariska's comment where she's mentioning that she liked the comparison that you made a few calls ago, about Neo being like a light switch, and if you just keep turning it back on and off and stuff, you're gonna just probably have a big divergence between the official account and your account. So it's not some. This is similar to the saying in equities that time in the market beats timing the market, and it would be pretty much something like time with Neo beats timing Neo. So yeah, it
Very
takes really
well
a
said.
lot. Yeah, and thanks, man. And it just takes a lot, a whole lot of stuff to happen in the markets for us to consider shutting down mode two. And as Rob said, he's more defaulting to running. I'm more defaulting to being more conservative. But altogether, when we do say, hey, we're not running Neo today, do whatever you want with that information, it just happens. I mean, I would just take that into account very, very on a very on a very strong way when I see that happening on the chat. Anyways, I think we should move into the quick closing thoughts for this call. We're about to overlap with Gearbox. So any closing
Everyone,
thoughts, gentlemen?
have a great weekend. Make sure to put your life savings into Dogecoin and Shiba Inu.
Come on,
Joking.
man.
I figure if Mariska wants to kill the call now or cut the call off, she can do it because it's the end of the call. So anyways, joking. I don't own any Doge or Shiba Inu coin, okay? Nick smiles. He's like, I got some.
Don't do your whole life savings. A little something wouldn't hurt.
Just get a loan if you don't have any life savings. What could go wrong?
Go walk that Doge, says Mariska.
Yeah, I'm about to go walk them right now. All right.
There we go.
Y'all take care. It's
Anyway.
great seeing you guys.
Take care. Have a good weekend.
Have a really good weekend and happy Friday to everyone. Have a good one.